Good morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange. We are now doing these weekly, and it's really just an opportunity to get the team together, hear thoughts on what's happening in the market, talk about some of our recent research. Today, we've got a group that's more North America focused because we really want to talk about the big news related to ExxonMobil and Pioneer. We're also going to talk commodity macro and lots of other things on the call. So quickly today, we'll run around the world real quickly. We've got Salih Yilmaz just attended a Gulf Intelligence Conference in the UAE. He's in the backseat of an Uber or a car of some sort, but he's going to weigh in here shortly. Swinging around, we've got Fernando, Valle, and Scott Levine at 731 Lexington, our New York City headquarters. We've got Talon Custer joining from an undisclosed location, I believe in New Jersey area. And then we've got Spencer Cutter joining us from the great city of Seattle. Our colleague Vince Piazza is also intending to join, but he's double booked, so we'll see if he makes it on for today. So the big news on the wire recently is the ExxonMobil Pioneer merger. I think the deal is just shy of $60 billion, $253 a share, about an 18% premium for Pioneer. So Fernando, given you look after Exxon, what do you make of the deal? And tell us how it could be. I think it's Exxon's biggest acquisition since Mobil. So tell us how
Yes,
you
I believe
how you
so.
think about it.
I think it's unlike the XTO deal, which I guess it's the easy to point to. Buying a large shale explorer towards arguably the peak. Some people would say peak oil, but as you know, we don't quite agree with that. But I think it creates. It really is the crowning jewel on the turnaround that Darren Woods has masterminded at Exxon. If you think about when he took over, Exxon was languishing. They had lost their returns on capital lead over Chevron, Total, and other majors because his predecessor, Rex Tillerson, had made some unfortunate investments, including XTO, but also in Russia and Canadian oil sands at what was the peak oil price at that point. I think Pioneer is different. He's buying premier asset. He's buying it at perhaps a middle of the range oil price, in an all equity deal that will allow Pioneers to capture this. But it creates a huge diversified company that I think benefits from the cost of capital advantage against smaller shale players. They will be the force within shale, and together with Chevron and ConocoPhillips and Oxy, they'll control over 40% of the output from the basin. So they'll have a lot of pricing power versus services versus midstream. They will really be able to create an integrated hub as well with their Gulf Coast assets. So it's a really interesting deal. And at today's prices, we think it's accretive from 2024, even if they don't reach that really ambitious $2 billion annual synergy target.
Okay, thank you, Fernando. Very interesting. So I think we've got a really wide range of stakeholders here on the call today that can weigh in on how this consolidation or deal within the industry may affect things. And Scott, I want to come to you next. It's not related to the deal specifically, but you actually had a note out just the other day talking about a slowdown in shale. And I know you look at rig counts and other things in that note, but I mean, what do you make? Does consolidation in any way affect your outlook for what's going to be happening in the shale patch in the U.S. in 2023, 2024?
Yeah, no, I think it does, Rob, and not in a good way, really. I think the point here is that the more consolidation that you see, the fewer number of players and the more clout that they have generally does not bode well for the service providers in terms of pricing power. And, as you mentioned at the outset there, we've seen the rig counts down 20% year to date in the U.S. That's certainly worse than we expected at the start of the year. We lowered our year-end rig count projection to 625, which is about in line with where it is now, from 700 previously. And this suggests to us, I mean, the oil and gas, the gas prices moved above $3 per MMBTU, so and oil price above 80. So the commodity price deck has generally been in a good place, but shale has underperformed nonetheless in terms of activity levels, and so given the reduced rig outlook, given the reduction in pricing power that we see coming from this deal and the Permian in particular, I would say they have experienced the largest decline in rigs on an absolute basis year to date, but the lowest proportional decline at about 12%. So, to the extent this adds pressure or increases, competition within the Permian Basin, that's the hotbed of activity for the oil field service companies. So in general, my take on the deal is bearish from the OFS point of view. We do expect at this point activity to ratchet up next year after budgets are refreshed, but certainly this year has been a disappointment from the OFS perspective. Yes.
All right, cool. Talon, let's bring you in next. You cover a number of the midstream names. Any sense on read across from consolidation, and what do you make about M&A in your space?
Yeah, so I'll echo what Scott said. When you have M&A and the E&Ps, there's a reduction in the rig count. They want to focus on cost savings and synergies. So from what I gather, Energy Transfer and Targa may be the most impacted. I think they had the largest market share of Exxon and Pioneer volume. So if it's less volume on their system, it's not good for them. And just like E&Ps in midstream, M&A has been going on for a couple years, and we expect it to continue. It's just a really challenging environment. So M&A is a viable growth strategy, right? You get to dodge the permitting headaches, you get to dodge the regulatory challenges, because it's almost impossible to build that much energy infrastructure in the company these days, especially interstate pipelines. So it's a way to optimize portfolios and reinforce strength. So I think we're going to see more asset level deals, bolt-ons with the occasional larger corporate deal peppered in. For those that follow the space, we just had ONEOK and Magellan close a few weeks ago, which was interesting because there was no product overlap. But I think the takeaway I got was that ONEOK needed to diversify away from the Bakken space, which isn't going to grow much, and Magellan acknowledged that there's limited runway for refined products. So in the space, generally larger is better. So that deal was all about scope. And of course, there's other pending deals. I mean, Enbridge has pending deals for 3 US utilities for $19 billion Canadian. So with that one, it's the regulated cash flows are nice, but it's also, it begs the question of were there not more midstream deals available to them? And I think with them, they wanted to diversify a little bit away from liquids and oil. So again, I expect it to continue down the road to kind of avoid that landscape.
Okay, thank you for that perspective, Talon. Okay, this is the first time we've had a credit analyst from BI on this exchange here, and so I want to come over to Spencer. You had a very provocative note on this topic as well. The title of it is Exxon could kick off consolidation wave of credit positive M&A. I'd love to get your thoughts on the deal and tell us about your thesis there, Spencer.
Sure. Well, thanks for having me. Yeah, you're usually as a bondholder, when you start hearing about M&A, your heart skips a beat because deals could obviously be funded with a large part of debt, particularly the extreme being an LBO. I think that's unlikely to happen this day and age with oil and gas producers. We had companies survive near-death experiences back in 2015-16, and then again in 2020, and since then they've been spending a lot of time, effort, and money in reinforcing their balance sheets. And one way that's been done, in addition to just paying down debt, using free cash flow to pay down debt or asset sale proceeds to pay down debt, is to do M&A deals. And if you look at the M&A deals done since 2020, the largest ones are almost all 100% equity funded. And again, on the Pioneer Exxon deal, again, it's a 100% equity deal. So you don't have any additional debt coming into the system. You have either a large company with higher credit ratings buying a smaller company with lower credit ratings. And in this case, this is very unlikely going to negatively impact Exxon bondholders, but it will very positively impact Pioneer bondholders as they see their credit profile go from a triple B to a double A, assuming Exxon guarantees the debt for Pioneer. And even if they don't, there's going to be an implied support there. The only deals that you've seen that haven't been 100% equity focused, or almost the only ones, are ones that involved financial sponsors, because obviously financial sponsor prefers cash. So there's been a few of those, but to the extent you're looking at a publicly traded E&P company merging, whether it's a larger company buying a smaller company, and size matters in this space from a credit standpoint, more diversity, more assets is better for bondholders. You're going to see, most cases, the smaller company bondholders benefiting. And even if it's a merger of equals, I do think you'll still, as long as it's a 100% stock transaction, bondholders will be better off. You're going from two smaller, mid-sized companies to one larger, bigger company without the additional debt put on from a cash-funded deal. So if this does kick off or extend the wave of M&A deals in the space, I think for most cases, bondholders should benefit. We'll see where that goes, but that's been the trend so far, and I don't see any reason why it should change, and this deal only reinforces it.
Okay, thank you, Spencer. Fernando, I want to swing back around to you. I know you have to run to another obligation, and I wanted to get your sense and tie with the Exxon deal and really talk more strategically. We are in a tumultuous time geopolitically. I think it might come to question, people may start to raise the question, how much can U.S. producer like Exxon bring to the table in perhaps an energy crisis? And so, is Exxon under this new paradigm going to continue to expand output? We've talked many times on this call about the sort of diverging strategies of sort of oil and gas focus versus oil and gas and clean energy focus between the U.S. and European majors. Is Exxon still going to be championing output growth, particularly as you look into the next few years with this deal or perhaps other activity?
Yeah, I think if you can take it from the horse's mouth, Darren Woods just had an interview with Alex Steele a little while ago, and he said as much. And also their target of 5 million barrels a day of oil equivalent by 2027 says as much, right? It would be the highest level of production out of Exxon in its history. So it's a very significant commitment to oil and gas, and reinforces our view that they don't believe in peak oil or the end of the oil and gas age in the near term, which we tend to agree with. He also, and Scott Sheffield reinforced this, something that we have put out a couple of days ago, which this likely drives more consolidation. There are only 3 or 4 players out there that can lead that consolidation. Your Conocos, your Chevrons, Occidentals, maybe an EOG Resources. As Spencer is saying, diversification is important in this next phase. But I'll say that one of the arguments for Exxon that Exxon made about security and increasing the security by having Exxon buy Pioneer, we tend to disagree with that, just because what you'll see from the combination is less activity, hence less growth, at least in the short term. They've argued that they'll increase the recovery, and longer term there'll be more production. I would argue that's still a little iffy, to say the least. But in the short term, it will likely mean slower consolidated production growth, and lower market share for the U.S. The one argument for security that I would make is that Exxon, because of its breadth and because of its balance sheet, will make it less volatile than if there were a bunch of smaller independent players who are probably now struggling to fund their capex with high interest rates, cost inflation in the shale patch, and just oil prices that are highly volatile.
Okay, very interesting perspective. Thank you, Fernando. I know you've got to run. Okay, Salih, I think this is a good point to bring you onto the call. We obviously have had a very significant geopolitical event happen over the weekend. very tragic in many ways, and unfortunately, there are implications for the oil market that I think we should discuss. Notably, we did see a bump in oil price following this weekend's events, and but I would caution that we are still quite a bit below even just a month or so ago, where we were much closer to $100 oil. We're about 87 and change right now. So I'd like you to give us some perspective on the sort of oil macro, the geopolitical tie-in. And I know you've been at a conference the last couple of days. What are you hearing in the region itself?
Sure. Thanks, Rob. Yeah, I mean, indeed, very tragic developments in the region since the weekend. And in terms of implications on the oil market, I mean, our first reaction was that this is going to be supportive for prices for a couple of reasons. I mean, this is not exactly a big oil producing region. I mean, the Levant region doesn't really produce them oil. So we haven't really had an immediate impact on oil supply. But still, our reaction was that oil prices will increase, and that's for a couple of reasons. One is, as you mentioned, I think this just pushes the general geopolitical risk premium in the oil market higher. Secondly, we think that, I mean, regardless of whether this escalates much further, we do think that the US administration is likely to start enforcing its sanctions on Iran a lot more aggressively, which would push the uranium output lower and probably prices higher. I mean, again, it's unclear the involvement of Iran in this exactly. I mean, they have confirmed their support for the Palestinian attack, but we haven't heard anything else. But generally, I believe the consensus is that it is likely that we will see stricter sanctions on Iran. And I should say this is important because when we look at what happened this year, perhaps the looser enforcement of these sanctions were the reason for the Iranian output to tick up since the beginning of the year. And I mean, this has been a significant amount. I think it's at least 500,000 barrels per day, probably a little bit more. So losing that would obviously be significant for the market and can be quite influential and supportive on prices. And of course, there is a probability that this escalates further and could see Iran and potentially Saudi Arabia get more directly involved, which obviously increases the risk of direct strikes or attacks on oil production facilities, perhaps similar to what we saw on the archaic facilities back in 2019. So that has generally been our thinking behind what can happen to the oil market, regardless of what happens to supply, but on oil prices. And in terms of OPEC, I mean, this has been what we've been hearing on one discussion point and some of the questions that we've been getting. We don't think that OPEC and OPEC Plus is going to change its strategy or boost output unless there is a significant spike in oil prices or a very obvious loss of supply elsewhere. So we don't think OPEC Plus is going to change its strategy. And generally, I mean, within this conflict going forward, I mean, obviously, the more the conflict spreads within the region, the higher the risk, of course, for supply disruption, and we think the higher oil prices can go.
Okay, thank you very much, Salih, for that perspective. It's not ideal to necessarily contemplate such things. And I want to come back to you, Scott, and have you share some thoughts on something we just heard from Salih. Salih talked about the potential for something in the neighborhood of 500,000 barrels per day of Iranian output potentially maybe going away because of this. And nobody knows for sure the exact number, but I've often thought of the US shale patches. It's increasingly become kind of marginal producer out there in the market. And you gave a pretty bearish outlook on kind of what's going on with shale. How do you think about a number like 500,000 barrels per day? Is that kind of growth potential even on the table at this point from the US shale patch?
I don't think so here in the near term. We've really seen, certainly from our vantage point, more of the growth outlook shift from the U.S., overseas. And last year, we saw very impressive growth out of shale. I think that was more a function of the fact that it was cut back more severely in response to the 2020, 2021 downturn and a bit of a catch up in terms of spending. But certainly this year, from the OFS point of view, much more of the growth has come from overseas, the Middle East, Latin America, and also, green shoots in offshore drilling as well. And so I think this year we will probably see spending growth in North America. I think it's maybe in the neighborhood of 5 to 10%, but that's below the 10 to 15 we probably expected at the beginning of the year. Whereas international is probably going to come in closer to like up 15 to 20%. And that's about in line with what we would have expected at the beginning of the year. And so I don't know whether it's a function of, shale becoming more exhausted in general, productivity gains offsetting some of the spending, and seeing production growth starting to move closer to flat, and OPEC also maybe resting some of that marginal producer mantle from the U.S. But I think certainly the shale is going to struggle to make that up, and I wouldn't expect them to here in the near term, certainly in light of what Fernando just said, as far as the implications of the Exxon Pioneer merger.
And Spencer, I want to come back to you and get perspective on the credit side of the equation around this. In Europe, increasingly these days, there's a lot of focus on green bonds and really the energy transition. Are U.S. credit investors wanting to deploy capital towards growing production? And is there an avenue for that happening, fueled by access to credit? So I'd love to hear your perspective.
Yeah, I think with the credit profile and the credit trend you've seen in the energy sector over the last, since 2020, really, which has been very positive, I think there's investors out there that are willing to lend to many of these companies for all sorts of different projects. It's just been a lack of demand from the producer side. You've seen most of the bond deals that you've seen of the last year have been M&A driven. And again, I just got finished saying most of these deals are equity, but again, smaller companies are doing smaller deals, and they're involving M&A, particularly with private equity being involved. But there's not a lack of demand, I don't think, from the buy side. I think they see strong credit fundamentals. They don't see any reason that's going to change anytime soon. From a green bond perspective, you're not really seeing green bonds come out of this space that I've been seeing, more of the utility side and some other areas. You have seen some credit agreements that have a green bond or green type feature where their borrowing margin drops or changes based on certain environmental ESG credit or ESG metrics, but those are pretty rare. I've only seen a handful of them.
Okay, very interesting. This probably be a good point to pivot to the other side of the energy equation and talk about gas for a little bit. So part of the portfolio that Talon covers is some of the LNG names, and I'll just frame it real quick here. We have seen apparently European gas seems to be reacting to some of the geopolitical risk. We're just shy of 50 euros a megawatt hour right now at TTF in Europe. So that's $15 per MMBTU versus Henry Hub, much closer to $3 per MMBTU. Always boggles my mind how big that spread is. But Talon, what's going on in the LNG space? Is there opportunity for some of the U.S. players to really perhaps benefit from some of that spread and geopolitical risk premium that we're seeing in the gas market?
Yeah, so the TTF benchmark, I think it jumped more than 30% from Friday. Main driver was the Middle East conflict. There's other supply risks, and with European storage at 97%, which is well above the 5-year average. It just goes to show how vulnerable the market is without getting that Russian pipeline gas. So, that situation, just like oil, is supportive of that price, and it benefits the exporters. The more LNG production that those U.S. exporters can push out, the better for them, to make the profits on those spot cargoes. And I will say, the other supply risk, right? We have potential strikes in Australia. We have the Baltic Connector pipeline that connects Estonia and Finland. There was a leak there. We have the Middle East conflict where, Chevron shut the Tamar field, and that provides gas for Egypt and Jordan. Now that means less gas for them, right? And Egypt was trying to resume LNG exports. They didn't ship any in August or September. There was high demand domestically because of heat waves and other matters. So they wanted to, resume LNG exports. But now with getting less gas, they may not be able to. In the short term, Egypt's not a huge LNG exporter. So in the short term, it's not going to be a huge impact on supply. But obviously, if that's prolonged, all the supply is key. And then just like what Salih mentioned, I think a key risk is escalation, because if Iran gets involved or other countries and there's any risk to the Strait of Hormuz or the Suez Canal, then it brings into question the Qatari exports, which, I doubt. I'm assuming the involved parties won't let that happen. But if, Qatari exports were affected, that would have devastating consequences for the global LNG supply. So again, just to hammer home the point, it just goes to show how vulnerable the LNG supply market is, even though storage in Europe and even in parts of Asia are pretty high.
Okay, thank you, Tal. And Salih, I want to come back over to you just on this idea of gas as well. You've numerous times over the years taken a look at gas supplies in the Eastern Mediterranean. Do you think that any of the current geopolitical factors will play into that narrative? Obviously, Talon mentioned what was happening with Chevron's operations there, but what's your read on the gas side of the equation? Well, we may have lost Salih. So, Talon, we'll come back to you, and we'll just give you a quick closing thought on the gas market. I think Salih has often noted that there's a lot of reserve potential there in the East Med, off Cyprus, Egypt, Israel. Kind of, it's potentially a gas-rich region, and I think the development timelines for a lot of that is quite extended. But what's your sense? Are folks perhaps still optimistic about the potential of developing new gas assets in the Eastern Med?
I mean, it's certainly current events complicate the situation, right? But there was a lot of potential. The Leviathan field, there's talks about multiple floating LNG units there to extract that stranded gas offshore and provide Europe or whoever wants to sign the contract. So, ton of potential. Like you mentioned, extended timeline, so it's not happening anytime soon. Hopefully, the current issues get resolved and it can possibly be added to the pipeline, but I think for now it's going to remain on the back burner. But again, certainly a lot of potential, a lot of gas reserves there.
Scott, because I know you held an event recently looking at offshore in oil and gas in primarily North America, I believe. But what's the role that offshore could play in the oil and gas over the next 5 years? I know the lead time tends to be a little bit longer there, but is that a piece of the equation that can help to balance the market if you look out over the medium term?
Yeah, I think so, Rob. Certainly that has been probably one of the stronger areas within our entire group, the offshore drillers. And we've seen probably the most activity from a contracting perspective in Brazil and South America. The deep water market has probably been the strongest subset. of the market. And at the event you just mentioned, they did mention Eastern Med as a potential, kind of quasi-frontier market, exploration activity picking up there, as well as some of the South American markets outside of Brazil, such as Guyana. Definitely over the longer term, and it is indeed, as you mentioned, a long cycle market. Increased confidence that with these prices, that a lot of the major producers are willing to move ahead with large projects, exploration activities that may not bear fruit for 3 to 5 years. And so, yeah, if there's one area probably have become incrementally more confident as we've become more bearish on shale and short cycle, it's on offshore drilling and long cycle. So yeah, I think the confidence levels regarding an upturn there after a multi-year downturn from 2014 to 22 is becoming increasingly visible, and I think you'll only see that continue to increase from here.
Okay, thank you. So I think we're at time. I'm going to just call your attention to a couple of things real quick. When we have breaking events like the ones we've seen this week, we have a react product. So if you pull up the Exxon primer that Fernando's written, or the Pioneer primer that Vince has written, and look at it, you're going to see their real-time take on the events related to M&A. And I'll highlight one from my franchise that's kind of on the periphery of our discussion here. Solar Edge, if you're unfamiliar with them, they're a key player in the solar supply chain. They make inverters, which help convert the DC energy from solar to AC that's on the grid. They are headquartered in Israel. They're one of the largest listed companies in Israel, in fact. And so, we put out a react about the conflict. And one of the things we would just note is that they have a lot of staff. About 55% of their employees are located in Israel. That being said, they outsource a lot of their actual manufacturing to players in other regions. So at least in the near term, we don't anticipate much disruption to their operations, but it's something to keep an eye on. So again, no matter what part of the energy value chain, whether it's credit or equity, whether it's oil and gas, wind and solar, BI is a place you can come to get a take on what the companies look like, what the markets look like. And we're always happy to have extended discussions. We're all green dots on the terminal right now. So shoot us an IB if you have any follow-up on what you heard here today. And like I said at the outset, we are doing these calls on a weekly rotation now. We've got too many people on the team to get everybody on one call, but we're going to be rotating. So you can see a lot of new faces. And so I just want to thank today for the first time to get, Talon on, to get Scott on, to get Spencer on. I know it's even a bit early for him. And we look forward to being in touch. I hope you have a great rest of your week. Take care, everyone.